Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
Okay, so today we're going to be walking through the U.S. Market Analysis Report from Friday, March 27th, 2026. Let's dig in and see exactly what it's telling us about the market.
And just so we're all on the same page, this video presents a direct informational narration of the source document. We're not adding any outside opinions here, just giving you a straight-up look at what's inside. Right, first things first, the risk disclosure. It's really important to remember that this document is for informational and research purposes only. It is absolutely not investment advice, and you should never take it as a recommendation to buy or sell anything. Investing, as you know, carries significant risk, and that includes the potential loss of your principal. So here's our roadmap. We'll kick things off with market performance. Then we'll get into the geopolitical situation that's driving so much of this. From there, we'll look at the technical selling mechanisms, the nitty-gritty of why the selling is happening. Then we'll explore some macro scenarios, look at flow dynamics, and finally, wrap everything up with the report's conclusion and outlook. All right, Section 1, Market Performance and Risk Premium Analysis. The report kicks off with a pretty stark warning saying that global markets are going through an exceptionally violent repricing. It's not just a simple pullback anymore. This has become a full-on systemic liquidation event. So the whole point of this report is to really get into the weeds of that selling pressure and to stress test what might happen. And you can feel it, right? U.S. equity volatility has just gone through the roof. What's really telling is that we're seeing oil prices spike at the same time that stocks are being sold off across the board. The report says this correlation is a clear sign of just how anxious the market is about two big things: second-round inflation and growth stagnation. Now let's look at the numbers from the close on the 27th. Brent crude is sitting at $106 a barrel, so that energy risk premium is back in triple digits. The NASDAQ 100 down about 2%, which puts it officially in correction territory. The S&P 500 dropped 1.73%, and it's getting dangerously close to that 10% correction line. The Russell 2000, which is all about smaller companies, was down 1.75%, which tells you liquidity there is just vanishing. And look at the market breadth. Just 111 stocks up versus 389 down. All of this just screams systemic liquidation. So how do we interpret this trend? Well, the report puts it this way. The market has shifted from a simple adjustment to what it calls a pro-max version of a systemic downdraft. This isn't just about energy costs anymore. We're in a liquidation phase with vanishing liquidity and what's called value-at-risk-driven deleveraging. And get this, the S&P 500 has now been down for 5 weeks straight. That's the longest losing streak since way back in May 2022. It's a sign that we're seeing a really deep structural reset of risk. Okay, now let's switch over to the geopolitical side of things, because this is really what's lighting the fire. Section 2 is all about this uncertainty premium. The bottom line is, things have moved from just talk to an actual war, and any optimism the market had has just completely evaporated. So, what's making investors so nervous? The report lists 4 key drivers. First, there was a credit breach and military escalation when a U.S. commitment to delay a strike got thrown out the window. Second, there's a certainty vacuum now, especially after Senator Rubio suggested the war could last 2 to 4 weeks. So much for a quick resolution. Third, we're seeing contradictory military signals from the U.S. that just aren't seen as strong enough. And finally, something to keep an eye on. There's chatter that Vitol, the world's biggest independent oil trader, might meet with Iranian representatives. Okay, let's get a little technical now and look at why this sell-off has been so brutal. This next section is all about the technical selling mechanism. The report explains that it's not just the big macro shock. Hedging from these quantitative strategies has basically created a self-fulfilling downward spiral, leading to what it calls a dual-trigger liquidation. A huge piece of this puzzle is the JPMC gamma strategy. You see, when the S&P 500 opened below a key support level at 6,475, it instantly put market makers in a tough spot, called a negative gamma position. This essentially forced them to sell to hedge their risk. And with a major options expiry on March 31st, they just can't provide the bids to support the market, which creates this incredibly fragile liquidity vacuum. And then, this is the real kicker. The index broke a super important level. It fell right through 6,381. Now, why does that one number matter so much? Well, that was the CTA terminal sell trigger, the final sell trigger for these big quantitative strategies. Once we hit that, it was like opening the floodgates for more selling. And that just created this vicious feedback loop between the futures and cash markets. In after-hours trading, S&P futures were down 1.95%, and Nasdaq futures were down 2.27%, both way more than their losses at the close. That's a really bad sign. It tells you technical momentum has completely fallen apart, and the market is bracing for an even bigger liquidity crunch. So, with all that, where are we headed? Section 4 gets into some macro scenarios. The report argues that the key variable, the one thing that will decide if this is just a correction or a full-blown financial storm, is how long the Strait of Hormuz remains closed and how much damage that does to the global energy supply. Yeah, just to really hammer this point home, the entire analysis hinges on this one single thing. How long is the Strait of Hormuz closed, and how bad is the damage to that energy lifeline? Okay, so the risk model here breaks it down into 3 possibilities. The optimistic or neutral case, if things get back to normal before the end of April, the S&P could find a good entry point around 6,100. But in the severe case, a closure lasting 2 to 6 months, that would cause a structural breakdown, and we could see the S&P down around 5,500. And then there's the extreme or crisis scenario. If this goes on for more than 6 months, we're talking about a global financial storm bigger than 2008, where all those technical support levels become totally meaningless. But there's one more core risk that the document says we have to watch with, and I quote, a high level of vigilance. That would be any kind of follow-up Israeli strike on Iranian nuclear facilities. The report is very clear. If there were a radioactive leak, the impact would be absolutely devastating. It would become the single worst-case scenario for the market. All right, so we've covered a lot of the bad news, but now the report pivots to look at potential opportunities in Section 5, which is about flow dynamics and positioning. The idea here is that even though things are pretty severe, when you get to the late stages of a liquidation like this, it can set the stage for a really powerful short squeeze. And let's look at the numbers behind that potential squeeze. It's pretty incredible. Since March, these CTAs have liquidated over $50 billion. They're still net short about $18 billion. This selling pressure is getting close to being completely exhausted. And the potential buying flow? It's sitting at the 99th percentile for the past year. That is a ton of dry powder that could ignite a really violent squeeze to the upside. So the report gives an example of how someone might think about building a position here, using Microsoft as a case study. It points to an initial accumulation zone below $375, but it also lays out some stress test zones at $346 and even a deep value area between $271 and $311. It also highlights what it calls a tail risk buffer zone for the S&P 500 itself, between $5,835 and $6,140, where if you are building a position, you absolutely must have a strict stop loss. Okay, let's wrap this all up. We're on to the final section, number 6, the conclusion and outlook. So what's the big takeaway? The report concludes that even with all the geopolitical uncertainty, the market's technicals seem to have gone through an initial washout. Looking ahead to what it calls a key macro game theory node at the end of April, the recommendation is to stay cautiously constructive and really watch those physical asset flows. The key, it says, is that at the peak of panic, it's critical to identify opportunities where valuations can snap back to the mean. And we'll finish up with the full professional risk disclosure. Please remember, this document is just for informational and research purposes. It is not investment advice, financial advice, or trading advice. The author is not a registered advisor. Any decisions you make based on this are solely at your own discretion and risk. And as always, past performance is never an indicator of future results. Thanks for tuning in.